This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. Caution in the markets ahead of the US inflation report as investors await clues on a possible Fed rate cut next month. Australia's Reserve Bank expected to deliver a 25 basis point reduction later today. President Trump extends the tariff truce with Beijing by 90 days, says he's open to Nvidia selling China a scaled-down version of its Blackwell AI chip. Also, the president changing his tune on Intel's CEO after their White House meeting, saying Lip-Bu-Tan has an amazing story. All right, let's take a look at how US futures are shaping up at the moment. We did see US markets closing modestly lower in the first session of the week. Pretty thin volumes, really, as markets await those CPI numbers for the month of July. That's coming out 8:30 a.m. Tomorrow morning, East Coast time. We are expecting to see headline data, or headline CPI, ticking up ever so slightly to 2.8% on year, but a deceleration on month. So we've got futures looking pretty flat ahead of that data. Not a lot of action there. Gold, I beg your pardon, not gold, oil also settling a little bit higher. We've got diesel in short supply in the US. We've got stockpiles of diesel at their lowest summer levels for a century now. We have refineries cutting back for maintenance in the US as well. And of course, this on the eve of hurricane season approaching. So crude prices ticking up just a little there as well. Not a lot of movement on the bond front. We did see bonds ending a 3-day losing streak again as investors kind of hang back, awaiting that US CPI data. We've got very sticky inflation in the US, but the labour market weakening as well, which does suggest the economy may need support. A few more names also emerging in terms of who will replace Jay Powell as Fed chair next year when his term expires. We'll bring you more on that story in just a moment. The dollar there at the bottom of your screen just strengthening a little as well. Let's take a look at how we're shaping up for the open here in Australia. We do, of course, have a Reserve Bank of Australia decision today. Futures pointing ever so slightly lower. Earnings season getting underway here as well. Bit of a quiet start, but tomorrow's when the action really starts. We'll have the largest stock on the ASX, Commonwealth Bank, reporting on Wednesday. Nikkei futures also a little bit softer. Japan, of course, returning to trade after a public holiday Monday. We'll be closely watching Rakuten. A very big miss there on second quarter operating income. That was reported on Friday, so it's really going to be the first chance for the market to react to that. The yen also looking pretty weak there, 148.20. We did, of course, as you see on the bottom of the screen, President Trump announcing an extension to the China trade truce for 90 days. There was pretty much no reaction at all to that. The market's really anticipating what we were going to see there. And that has averted a tariff hike, at least, of 54% on Chinese goods. That was all due to take effect this week, not happening now, obviously. The president also signalling that he's open to allowing Nvidia to sell China a scaled-back version of its most advanced AI chip. Let's get a little bit more on this now. China's correspondent, Bloomberg's China's correspondent, Min Lo, joining us. Also joining us, executive editor for technology, Tom Giles. Min, I want to start with you on the tariff truce, a 90-day extension there. I mean, probably unsurprising news, but what happens next?
Yeah, as you said, it's well anticipated. Not much movement in markets as well. You look at the USD CNH barely budged there. And this comes after the Stockholm talks, right, that went pretty well. At least the signals from both sides show that they seem quite satisfied with the talk. And this essentially kicks the can down the road for another 90 days. Potentially, it paves the way for President Xi and Trump to meet perhaps sometime around October at the sidelines of the APEC summit. We might hear more more substantial outcomes after that potential meeting between the two leaders. But of course, now there are still quite a number of issues that both sides will want to resolve. China, of course, will want to remove that 20% fentanyl-related tariffs. It wants more access to U.S. advanced chips, while the U.S. had been threatening secondary tariffs on China for its purchases of Russian and Iranian oil. President Trump yesterday also posting on Truth Social, calling for China to quadruple its soybean purchases from the U.S. Plus, there has been the latest development, which is Trump signaling that he might be willing to allow China to access the latest Nvidia chips, the Blackwell series. Have a listen.
I deal with Jensen, who's a great guy, and Nvidia. The chip that we're talking about, the H20, It's an old chip. China already has it in a different form, different name, but they have it. Or they have a combination of two will make up for it and even then some. The Blackwell is super duper advanced. I wouldn't make a deal with that, although it's possible I'd make a deal, a somewhat enhanced in a negative way Blackwell. In other words, take 30% to 50% off of it. But that's the latest and the greatest in the world. Nobody has it. They won't have it for 5 years. But the H20 is obsolete. You know, it's one of those things. But it still has a market.
All right, so Mim, the president signaling there that maybe a scaled-back version of the Blackwell chip may be made available to China, but would China want it? We were discussing yesterday that they're a little bit unsure about some of the security vulnerabilities of the Nvidia chips that they're allowed to access now.
That's right. China can now only access the H20 chips, which is the older version, the Hopper series. And this is something that Nvidia has said can't be scaled back even more. But the latest Blackwell chip, a scaled down version of that, might still be attractive to China. Now, the reason why China has not been so hot on the H20 chips is not only because it's not very advanced. You know, China can already produce chips that can achieve, you know, the same level of impact if it combines some of its existing chips together. And so that's one, plus the security risk. So, of course, China will still want some sort of reassurance that those chips that Nvidia is selling to China will not contain any backdoor to the U.S. government. But the advancement of the next line of chips, that could potentially be something that China would be interested to get its hands on. But, of course, as you said, the security risks still there. That's something that both sides will have to work out. And China will likely continue to pour resources to try to reduce its reliance on U.S. chips.
Yeah, I want to get a little bit more on this. Let's bring in Tom Giles now. Tom, Min mentioned the security risks from the China point of view, but what are the security risks from the US point of view? This sort of technology is subject to export controls. Is that now up for negotiation?
Well, you know, for the right price, we can rethink just how concerned we are about the national security implications. But specifically with regard to chips, the U.S. government has historically put strict limits on what kinds of chips can be sold to China. And as Trump said in that clip, that if there are scaled back versions, if there are ones that are not the most advanced, he'd be willing to cut a deal with a company like Nvidia, like the one that's already been announced with AMD and Nvidia on another chip. He'd be willing to make some compromises, make some concessions. The argument being these are not the most advanced chips. The argument being that, well, these don't have the same national security implications that the most advanced chips do. What this is a recognition of the vital importance of the Chinese market to these chip companies. And it also is a recognition that Chinese customers are interested in getting NVIDIA, AMD chips within reason. Remember that the Chinese chip makers are starting to catch up, and that sends, that gives U.S. chip makers a lot of fear and trepidation. They say we need to stay in the market. We need to stay ahead of companies like SMIC, like Huawei, and we need to continue to sell our chips into the Chinese market. And they're willing to make concessions, 15%, in order to continue to do that.
Tom, we also had the president meeting the Intel CEO Lip-Bu Tan as well. This is just days after calling for his resignation as CEO of Intel. Now he's got an amazing story. We've all got an amazing story, haven't we? Is this enough to save his job? What got said?
Well, he needed to kiss the ring. You need, as an executive of an important American company, you need to demonstrate your willingness to pay some homage to the Trump administration, show up in D.C., tell your story, explain why you're past. In Lip-Bu Tan's case, he's been on the board of Chinese companies. He's invested in a lot of Chinese companies. And he was the CEO of a company that got in some hot water with the U.S. government. All those things taken together raised concerns on the part of some lawmakers that there might be some conflicts of interest, that he may not be as devoted to the U.S. as he should be. Liputan wanted to send the message that's not true, that's misinformation. He wanted to send the message to the Trump administration that we're here to do business. We want to see manufacturing come to the U.S., come back to the U.S., particularly in the area of chips. As we all know, Intel has struggled in this regard. They've fallen behind, particularly TSMC, Nvidia, some of these other companies that just do it better than they do. And Liputan has a big job ahead of him, and he can't afford the president calling for your resignation.
Look, more broadly, we've got a situation with the president calling for the resignation of a CEO of a major tech company. On the other hand, AMD, Nvidia, yeah, it's okay to sell a scaled-down version of their product into China if the U.S. government gets a cut. Is there any broader concern here about political overreach in getting involved in corporate decisions? Is there any disquiet over that?
There absolutely is concern over that, as there should be. Should these kinds of decisions be politicized? Should the U.S. government, which is trying to argue to our closest allies that we do need trade sanctions because of the national security implications, you need to be on our side, you need to join us in alliance against, say, China. On the other hand, we'll cut a deal for the right price. We can make some concessions. That does send mixed signals to our closest allies, and it could complicate U.S. efforts to get other allies on board. Also, if you're a U.S. corporation, how much do you want the national government, the federal government, to be interfering with the way you do business? In some instances, your interests may be aligned. In other instances, there may be cases where you are being asked to make compromises. You're being asked to remove an official, for example, who you don't think should be removed, or you're being asked to ante up a percentage of your sales. What does that do to margins? And at what point do investors start to lose patience with this kind of deal making that's so prevalent with the Trump administration?
All right, Bloomberg's China correspondent Min Lo and our executive editor for technology there, Tom Giles. Well, the Trump administration is said to have expanded its list of potential new Fed chairs. Officials say the central bank's two vice chairs, Michelle Bowman and Philip Jefferson, are now also under consideration, and that's along with Dallas Fed President Lori Logan. Senior editor Derek Wallbank joins us with more details now. So, Derek, the list of potential candidates expanding. Could we say any candidate is in front? Are there more to come? And what's the likelihood that any of them would do the president's bidding anyway?
Well, Paul, look, it's a lot to take in, but I'll give you the best that we have right now. You know, we are hearing, as you said, that the list is expanding. The list of potential finalists is expanding. Scott Bessent, the Treasury Secretary, who Trump said did not want the position, is one of the key people involved in this process. You know, the decision ultimately is going to be a Trump decision. The list of this, you know, depending on who you talk to and what your definition of the word final among the finalists is, can stretch 6 up to 10 maybe, somewhere in that level. But we are thinking, I think the thinking in Washington so far kind of centers around Hassett, Warsh, and Waller right now. As I say, that list is going through an expansion phase. It's going to come into a contraction phase. You know, Trump had a period of time where he might have been in a position to name somebody last week to kind of go through and say, all right, this is who I want to go for. He took a temporary position there and said, nope, let me do a temporary pick to fill that. That bought him a little extra time. So Trump is not necessarily, under the gun to do this right now. He can take another, period of weeks to months to sort of figure this out. The ultimate question that you referenced, though, which I think quite rightly, is what is this person going to do? Who is the vessel that's going to achieve the outcome? And the outcome that Donald Trump wants is to lower rates. He's been heavily critical of the Fed for not having lowered rates already, and not lowering them, maybe more than some trajectories have anticipated. So who is going to be the vessel for that? That is one open question. What does Donald Trump want this person who gets this appointment to do? I don't think that there's any doubt in anybody's mind about that.
Derek, on the subject of civil servants and being compliant, there is a new head of the Bureau of Labour Statistics, E.J. Antoni, going to replace the outgoing head after President Trump didn't like the data. Now, this does raise an interesting question, doesn't it? If you change the leadership of the agency and then the numbers change, well, it does suggest that they were either wrong before or they're wrong after. Are we heading down an interesting road here?
The Bureau of Labor Statistics is one of these agencies in Washington that is incredibly boring. It is one that is meant to be drama-free. It is one that is meant to be, sort of, it pops up when it puts out reports and then it pops back down and it does its work and so on and so forth. This has been a period of intense media focus for BLS, the likes of which I cannot remember in my long career of covering the United States government. This is a pretty unusual situation. Now, Trump has named E.J. Antoni, who's the chief economist of the Heritage Foundation. Antoni was one of these people, interestingly enough, he went on Steve Bannon's podcast after the last jobs report, was asked if there was a MAGA person atop BLS and basically said, no, there wasn't. Trump in this announcement does say, I'll just read it here, quote, our economy is booming and EJ will ensure that the numbers released are honest and accurate. The words honest and accurate in all caps. Now, if you get into any sort of discussion about that the BLS numbers aren't honest and accurate, you do get into very difficult things very quickly, because this is jobs, this is inflation, this is all sorts of other big economic prints that come out and aren't just, these sort of ideas of where do we think things are, but are, the baselines for a lot of other things. A lot of the financial world is built on these analysis points, and they are generally considered to be a gold standard. That having been said, there has been a lot of question about the revisions that have taken place there, and there has been a lot of difficulty that BLS, as well as a lot of other surveying outfits in the United States and around the world, have had about getting the true measure of the economy and trying to figure out where exactly that is in an age where fewer and fewer people are picking up their cell phones or wanting to be interviewed or anything like that. So this is not like an only in the United States problem, but this situation here is one that has boiled over, and Antoni will be under an exorbitant amount of pressure to prove to lawmakers and to prove to economists and to market participants that the BLS numbers are accurate, they were accurate, and they will be accurate.
Yeah, and of course, let's not forget, a strong jobs market would suggest there's no need for the Fed to ease. So maybe that's a conversation for another time. Bloomberg's Derek Wallbank there. Still to come, the Asia Society Policy Institute weighs in on the US-China tariff truce extension. UBP tells us why they continue to favour US tech stocks, and we'll take a closer look at Australia's earnings season with JPMorgan. First, though, President Trump downplays expectations for his summit with Vladimir Putin, saying it's not up to him to deliver a Ukraine truce. We'll have details of that next. This is Bloomberg.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed.
President Trump there playing down expectations for his upcoming meeting with Russian leader Vladimir Putin as he seeks to end the war in Ukraine. For more, Bloomberg editor Mike Heath is with us. So, Mike, a feel-out meeting, trying to get the lay of the land here. What's a realistic expectation in terms of outcomes?
Yeah, well, I mean, it really depends on what Putin wants here. I mean, he holds all the cards to some extent. So, in a way, I guess there's two scenarios. One is that Putin sticks to his maximalist demands, and if Trump is as good as his word, he walks away and says, well, good luck, and everybody supports Ukraine and we continue as before. And now that could be, okay for Ukraine if the US then provides it weapons, but it hasn't really been going overboard. It hasn't been doing that too much anyway. So the best case scenario is Putin does come up with some sort of deal that doesn't require Ukraine handing over land that's not occupied by Russian troops. I mean, we've sort of seen even Ukraine. We've got reports that in discussions with Western leaders, Ukraine has basically conceded that it would be prepared to cede some land that's under Russian control. So Putin coming to the party in that sense, I think, is probably the best case scenario we'd find.
Does that already look like a win for Vladimir Putin? If that deal is struck, that would mean he holds a fifth of Ukraine's territory based on 1991. He's already been back for a second attempt after Crimea. Who's to say there's not going to be a third attempt?
No one's to say, Paul. And this is the crux of the matter, because, I mean, peace, J.D. Vance said it very well. Basically no one will be happy with a peace deal, and that's generally how it works. But how it should work is that Russia will get some of this land. It doesn't deserve it. It shouldn't get it. Morally it shouldn't get it. But there is also, it's a big military machine that's hard to fight off. But Ukraine needs security so that Russia doesn't come back. Now, the Trump administration's all but ruled out Ukraine ever joining NATO, which is another win for Putin. And the strength of the West in terms of holding off Russia if it chooses to have another bite at this is very debatable. So, yeah, I mean, you do, aggression works, and I guess throughout history it has shown that. And Putin always knew it. He always suspected that the West would cave. And again, his view that if Russia can hold the line here, it will be successful, will be vindicated.
Just moving on to the other conflict that we generally talk to you about, of course, what's happening in Gaza. We've got now Norway's sovereign wealth fund, $1.9 trillion fund divesting its Israeli assets. How significant is this? How's it going to affect Israel? Yeah, well, I mean, I think it's just, I don't think it's going to be a huge economic issue for Israel. I mean, the Norwegian fund has said that, it's 11 firms that it's divesting from that are sort of related to the war in Gaza, which, it sort of has described, as everyone else has, as a humanitarian disaster. It's more grist to the mill, in fact, in sort of this pressure on Israel that's building, even among its friends. That in Europe, we see even Germany, which has this, because of its history, strong ties with Israel, getting more critical now, refusing to sell weapons to Israel. So it's just another brick there when in terms of this grouping, pressuring Israel to stop what's going on there. But again, Israel has the US behind it, and while it has the US behind it, it's going to feel pretty confident that it can push through here. All right, Bloomberg's Michael Heath there. We have more ahead on the Asia trade. This is Bloomberg. Let's get the latest from the corporate front. An explosion at a US steel plant in Pennsylvania has killed at least one person and injured 10. The company says the incident involves coke oven batteries at its Clairton plant. US Steel CEO David Burritt says the firm is working closely with authorities to investigate the cause. The plant has a history of accidents and violations, including an explosion and fire in 2010 that injured 15 people. Paramount is buying the exclusive rights to show all events from the Ultimate Fighting Championship in the US. The 7-year deal is worth $7.7 billion and bolsters the Paramount Plus streaming service. UFC owner TKO Group jumped 10% in New York trading. Paramount says it will also look at buying international rights in the future as they become available. More ahead on the Asia trade. This is Bloomberg. Okay, we're about 30 minutes away from the open here in Australia. Japan also returning to trade after Monday's public holiday. Futures looking a little bit softer at the moment. We did see the ASX hit a record high yesterday, helped in no small part by the materials sector. That performed very strongly, particularly lithium miners having an excellent day. Nikkei futures off by about 0.25%, though. We'll be watching Rakuten after it had that big miss on Friday. First chance for the market to react to those earnings. price. E-mini futures in the US, meanwhile, looking pretty flat at the moment. It didn't move after we saw President Trump extend a pause of those sky-high tariffs on Chinese goods into early November, which is stabilizing trade ties between the world's two largest economies. Well, let's bring in Wendy Cutler now, Vice President at the Asia Society Policy Institute, and she previously served as the acting Deputy U.S. Trade Representative. Wendy, thanks so much for joining us today. I want to start with that extension to the truce. I mean, the market expected it, you expected it, I think we all expected it. Every other trade deal has been concluded very quickly. What is the pace of this one telling you?
Well, there's not a lot of time for these negotiations to proceed, so I think it's extremely important that that both sides have agreed to a tariff rollover, so now they can really put their energies and attention on the key outstanding issues, including export controls, critical minerals, excess capacity, you name it. There's lots of issues on the agenda and not a lot of time to come up with negotiated solutions.
Let's talk about some of those export controls. But, we've been discussing this today on the show. President Trump is looking at allowing Nvidia to sell scaled-back Blackwell chips to China, considering that. But what does that tell you about national security? And is that now on the table as something that can be negotiated?
Well, I have to say, during my career negotiating with China, whether it be for Republican or Democrat administrations, our position was we're not negotiating on export controls. Therefore, national security reasons not on the table. The Trump administration now has opened the door, and China is going to take advantage of that opening. And I'm sure top on its list is going to be not only a standstill on new export controls, but looking for rollbacks of existing export controls that's going to just really make these negotiations more difficult.
Yeah, so what are some of the risks that this opens up in your view?
Well, it basically means that the United States is going to have to make a decision. Does it supply China the types of chips that it really wants and needs to bolster its own advanced AI and high-tech industry? Or does it kind of double down and say, you know what, we're not going to supply these chips and other high-tech goods? So it's going to be difficult, and I think there are probably a lot of internal discussions going on in the administration, because I don't think everyone's probably on the same page as the president on this one.
Yeah, look, China obviously holding a lot more cards than a lot of other trading partners with the US, particularly when it comes to rare earths. So how do you see China using this to its best advantage, and how's that going to inform the contours of an eventual deal?
Well, exactly. I mean, China comes to this negotiation in a much stronger position than it did during the Phase 1 trade talks during Trump 1.0. And it has discovered and already exercised and used its leverage with respect to access to critical minerals and magnets. So it's going to use that card to basically try to achieve a more balanced deal with the United States and use it as leverage if it doesn't like what the U.S. is offering to it.
Can you foresee a scenario where anything new gets put on the table during the next 90 days?
Look, I think there's lots of emerging issues that could be put on the table. But again, not a lot of time. So what I'm hoping, even if a limited deal is reached and both presidents announced the deal, that there is a process going forward to address other issues that weren't part of the initial deal. I think that's going to be critical if such an agreement's going to be credible and meaningful and durable, frankly.
Yeah, in terms of other issues, I mean, China, along with India, is a major significant buyer of Russian oil. But unlike India, China's not really facing the same pressure from the United States. What's going on here?
It's unclear, but the president has been very firm with India, threatening an additional 25% tariff in 14 days if India doesn't stop buying Russian oil. And India is saying, well, wait a second, why us? Why not China? So the administration has left open the possibility of pressing China on Russian oil purchases, but to date, we have not seen that materialize in any tariff threats.
Well, President Trump is supposed to be visiting Beijing within this 90-day window. Do you have a sense that by the time that visit rolls around, the White House would like something to announce? And what do you think that might be?
Exactly. I don't see this meeting taking place unless proper groundwork has been laid, including some type of trade agreement. The agreement may be focused on commercial aspects, including announcement of new mega purchases by China. But again, if that's all the agreement encompasses, I think folks are going to be very skeptical of this deal, because we remember during the Phase 1 talks during Trump 1.0, China made similar pledges but did not follow through with them.
One of the other developments we've seen today is that the U.S. would like China to massively increase its purchase of U.S. soybeans, up to 4 times the amount. Do you think that that's a realistic expectation?
Look, I don't think 4 times is, but I would not be surprised if soybeans and other agricultural products are not on the top of the shopping list that we give to China. Important constituency for the president, and he's going to need to show the farmers and ranchers in America that he's doing everything to fight for them. But in the meantime, guess who? We are not the largest soybean supplier to China anymore. They have diversified. They are relying now on Brazil. And so, again, this is going to be a difficult road forward to get China to, again, depend on us for soybeans after they learn their lessons during the Phase 1 talks.
And of course, China's not just negotiating in isolation with the United States. I mean, it's been on something of a charm offensive in the Asia Pacific. The Australian Prime Minister Anthony Albanese was recently entertained on a long 6-day visit with a variety of indulgences. How do you see China building up its relationships in the rest of the region to reduce its dependency on U.S. trade?
Well, look, our trading partners are looking to reduce their dependency on the United States, and China's door is open. That said, it hasn't been smooth sailing for a lot of these countries with China, particularly as China dumps a lot of its excess capacity of manufactured goods all around Asia and Europe. We've seen spikes in Chinese exports to Southeast Asia and to Europe. So I think these countries are going to be somewhat wary to get too close to China now.
All right, Wendy Cutler, Vice President at the Asia Society Policy Institute. Thanks, as always, for your insight. Let's take a look at how a number of key commodities are tracking at the moment. We've seen normality return to the gold market. We did get a post on social media from President Trump saying, and I quote, "Gold will not be tariffed!" ! There is no formal policy on this yet, but of course there was some confusion over whether 1 kilogram 100-ounce bars were going to be subject to tariffs. We saw the price differential between New York and London widen, then narrow again, and now we're back to where we were a week ago before all that drama unfolded. A bit of a modest uptick to crude prices there. We were discussing soybeans a moment ago with the U.S. demand that China quadruple its imports of U.S. soybeans. So we're seeing soybeans ticking up there by 2.4% at the moment. Iron ore price also holding pretty steady right now. We have seen some steel mills in China closing due to pollution issues for the summer. That's helping support iron ore prices. And we've got copper prices catching a bit as well. Lithium, as I mentioned earlier, was performing very strongly yesterday. Lithium miners among the top 3 on the ASX after we saw CATL, a mine that is a critical supplier for lithium to CATL in China, being temporarily suspended. So we'll see if lithium prices and lithium stocks are able to hold up with that sort of strength today. For more on all of this, let's get to Asia Energy and Commodities editor Andrew James. So, Andrew, I just want to start with all that drama around gold. Can we now draw a line under that? Is it crystal clear that gold is not subject to tariffs?
It appears that way. It appears that sanity has prevailed. This was initially sparked by an FT report late last week based on a letter the US had sent to a Swiss refiner saying that they were going to face big tariffs on gold bars. As we know, gold's essentially a currency. And a lot of gold bars moving around the world. Central banks hold a lot of them, so this would have essentially been a tariff on what is almost a currency. And we saw the US gold price shoot up dramatically on Friday. This would have caused big dislocations between the benchmark price in London and US prices. Also would have effectively kind of gummed up the market. So it appears sanity has prevailed. Trump's come out and said it won't happen, although, as always, we don't have any details yet.
Yeah, we'll wait for more. Well, we have that social media post at the moment. But I want to get your views on what we're seeing with iron ore as well, because it's showing, well, some might call it surprising resilience, considering the economic outlook in China. So mills, a number of steel mills closing in China, that is helping support the price. But how sustainable is that?
Well, this is in Tangshan, which is a major steel-making hub. It's quite close to Beijing, and the reason they are suspending some activity there is there's a big military parade coming up in Beijing on September 3, so this is designed to ensure clear skies for the parade, and it's not unusual for Chinese authorities to do this, so this is giving prices a short-term bump. I think the bigger question, though, is the extent that steel mills get caught up in this stepped-up efforts by Beijing to tackle overcapacity. They've really sort of moved in the last few weeks to tackle overcapacity. So China's been producing way too much steel over the last few years, and is the government really going to seriously crack down on that production? That would affect the market in a couple of ways. On the face of it, if you produce less steel, you need less iron ore, so you might expect prices to drop. But on the other hand, it would improve margins at steel companies, be good for the whole sector, and that might push prices up. So we've actually seen prices moving up more on hints that this is going to happen.
Yeah, there's similar questions about the sustainability of the rally that we've seen in lithium miners, which kicked off in earnest yesterday off the back of that suspension of a mining permit in China. So you look at some of the gains we saw for lithium stocks. Can they be held on to, or could we maybe expect to see a pullback today or later this week?
Well, this again is part of this effort by China to tackle overcapacity. They call it anti-involution is the term they use in China. So CATL stopped production at a big mine which accounts for about 5% of global lithium production. That was because they didn't get their license extended by the authorities. So this is part of authorities' effort to tackle a big glut in the lithium sector that's been going on for a couple of years now. There are other mines in the area where the CATL mine is that account for about another 5% of global production, so a lot of attention will be on whether they get licenses extended. Do they are they able to keep producing? So I think those are the big questions. Perhaps some of the reactions yesterday were a bit knee-jerk. We did see dramatic rises. They might come back a bit, but I think the sense is that China is now starting to get serious about tackling the lithium glut, and that's in the wider context of this big sort of drive to rein in overcapacity in lots of sectors across the economy.
All right, Asia Energy and Commodities editor Andrew Janes there. Some of the other stories that we're following. President Trump has announced a federal takeover of the Washington, D.C. Police Department and the deployment of 800 National Guard troops to the Capitol. He's also threatening to send federal personnel to New York and Chicago if local leaders fail to curb what he calls out-of-control crime. The most recent statistics show violent crime in Washington, D.C. fell last year to a 30-year low.
We are American citizens. Our families go to war. We pay taxes and we uphold the responsibilities of citizenship. And while this action today is unsettling and unprecedented, I can't say that given some of the rhetoric of the past, that we're totally surprised.
Two Chinese ships have collided after one of them chased a Philippine Coast Guard vessel in the South China Sea in the latest encounter between the two nations in the disputed waterway. The Philippine Coast Guard released video and photos of the incident, said to show a China Coast Guard vessel hitting a Chinese Navy ship. The Philippines says the China Coast Guard ship suffered substantial damage. Still to come, we're counting down to an expected third cut by the RBA this year. We'll discuss the coming decision with Bloomberg Economics next. This is Bloomberg. Okay, we're about 12 minutes away from the open here in Australia. We've got the Aussie dollar holding pretty steady, just above 65 cents. We've got futures pointing down a little bit lower. Big week, of course, a lot of earnings out this week starting today. Well, we do have a number of stocks out today, but tomorrow things really ramp up with Commonwealth Bank, which is the largest stock on the ASX by weight. We'll also be hearing from the energy generator AGL and the gold miner Evolution tomorrow. But, of course, a lot of the focus going to be on the Reserve Bank of Australia today, seen easing by 25 basis points, making it the third cut this year. And all 36 economists in that Bloomberg survey expect us to get that cut today, which comes as labour market data indicates more slack than the central bank had projected back in May. Also predicting a cut today, in good company, Bloomberg economist James McIntyre. Now, James, the market was surprised at the last meeting that we didn't receive a cut. You were not. What's leading you to expect the RBA will ease this time?
Yeah, thanks, Paul. So we didn't think that they would cut last time because there was no clear reason to. The RBA said that they're going to be delivering gradual, data-dependent easing. There's no big problem within the economy. There's a lot of little problems, but there's no burning platform in which they had to cut. As we fast forward to the August meeting, it's going to be their big forecast review. They've got inflation in line with what they're expecting, and they're expecting it to move in a way that would allow them to cut. But what's changed since July is the labour market. Not only did we get the unemployment rate be a little bit higher than the RBA's projections, but some of the information that they relied on for that July decision, that unemployment rate, the back data got revised upwards. So we've got a bit looser labour market than what they thought. That, with inflation being well behaved, that's enough, we think, to get that next gradual dose of easing from the central bank. Yeah,
so jobs, inflation, these are the key things for the RBA to consider. But how about the macro environment, particularly tariffs? Does that feed in?
Yeah, tariffs are not a huge direct impact for Australia's economy, but the indirect impact and the uncertainty shock that tariffs are delivering, not only to Australia, but to the global economy, that's something that the RBA is going to be focused on. We're worried, they'll be worried that it might see consumers and businesses sit on their hands. We've got a big transition underway in Australia's economy this year that the RBA is hoping for, moving from a public sector demand-driven growth in 2023 and 2024, with the private sector and business investment in particular really picking up. If consumers don't open their wallets, let's say that they're concerned and uncertain, if they sit on their hands and don't spend, we won't get that recovery coming through, and that's something the RBA is going to look for, and it might be something they have to prod consumers into later this year or next.
Well, as you mentioned, we do get a new set of forecasts today as well. How are you expecting that to be reflected in some of the commentary and the path ahead for future rate cuts?
Yeah, I think the RBA's commentary is likely to stay with you might call it a hawkish cut, but stay with the gradual data-dependent easing. The RBA is going to extend their forecast profile by another 6 months. Now, when we take into account that unemployment rate we spoke of just earlier, that being higher, that means that there's downward pressure in the way that their models will work out, and all economists will do the same. We'll be looking at downward pressure on the inflation at the end of the forecast profile. That'll drag them over the line to cut, especially as it's been lengthened out. So, that'll be enough to get them over the line today. No big clear guidance that they're going to be turning up at the next meeting. However, the meeting after that, where they get another set of forecasts, another big quarterly inflation data, we think that November cut is more likely to be the next step from after today's easing.
All right, Bloomberg economist James McIntyre there. And subscribers can also turn to the terminal for more on this. TLive Go, TLIV Go, that is your function for the latest updates, plus commentary and analysis from our expert editors. We have more ahead on the Asia trade. This is Bloomberg. Time to take a look at some analyst calls ahead of the Asia trading day. A monthly Bank of America survey shows a record number of fund managers see U.S. stocks as too expensive after the sharp rally since April. About 91% of the participants indicated that U.S. equities are overvalued, and that's the highest ever proportion in data going back to 2001. Bank of America strategist Michael Hartnett says investors now see the lowest probability of a hard landing since January. Goldman Sachs economists say U.S. companies have so far taken the bulk of the hit from tariffs, but that will soon change. If the pattern of levies follows previous ones, then consumers will end up absorbing 67% of tariff costs. The result, they say, well, it'll be faster inflation. All right, let's check one of the stocks that we're going to be watching when trade opens in Australia, Korea and Japan shortly. We will be keeping a close eye on Rakuten. Rakuten reported numbers on Friday after the close, and they were a big miss on second quarter operating income. Net loss 50 billion yen. That was versus an expectation of 20 billion yen. Rakuten Bank, though, did at least have one bright spot. The bank up 54% on year, and that was a beat. No dividend, though, so keep an eye on that one when we get going. Japanese assets more broadly, meanwhile, we're seeing Nikkei futures just flipping positive now, better by 1%. Japan, of course, returning after that public holiday on Monday. The yen still looking pretty weak at 148. We have market opens in Sydney, Seoul and Tokyo next. This is Bloomberg. This is the Asia trade, and we are counting down to Asia's market opens. We did have futures pointing slightly to the upside ahead of the open. We did have a little bit of news flow as well from the White House. In the most widely anticipated news of the week, I think, the US and China extending that trade truce to a further 90 days. And during that period, President Trump will, in fact, visit Beijing. So plenty of time yet for those two to reach an agreement. There was no appreciable movement on markets as a result of that. As I say, it was widely anticipated. We have seen bonds also ending a three-day losing streak. We are, of course, counting down to that critical CPI data in the US for the month of July. We're expecting a slight tick up there to 2.8% on year. So here we have the market open immediately. We're seeing some decent gains for the Nikkei, better by about 2/3 of 1%. Japan, of course, returning after that public holiday on Monday. One stock we're focusing on there is Rakuten Group. Is up about 2%. This is despite reporting some somewhat underwhelming earnings at the end of the weekend. Big miss on second quarter operating income, as I mentioned a moment ago. Rakuten Bank, though, was up 54%. No dividend from Rakuten, but that stock's still higher now by almost 3%. Take a look at the yen. That's pretty soft, although perhaps a function of some of the gains that we saw in the US dollar. Switching over to Korea, let's take a look at how the Kospi is tracking at the moment. We've got some modest gains there as well, better by about 1/10 of 1%. The tech-heavy KOSDAQ index also in positive territory. I want to take a look at the ASX as well. It's an important day here in Australia. We do have the Reserve Bank of Australia widely expected to cut. In fact, I think it's 100% of those surveyed think we will see 25 basis points worth of easing today. Also, the kickoff of earnings season here in Australia. At the moment, though, staggered open. We do have a little bit of softness on the ASX, but let's check in a bit later and see how we're tracking. Do want to get to some breaking news, though, out of Singapore. It is final GDP for the second quarter, coming in very much as expected, rising 4.4%. That is exactly what the market was anticipating. The top three positive contributors to GDP growth that quarter: wholesale trade, manufacturing, finance and insurance sectors. The construction sector also grew by 6% on year. Services producing industries growing 4.3% on year. That was a pretty decent pickup on the previous quarter as well. Of course, when it comes to Singapore, we have seen a fair bit of front loading going on in terms of businesses accelerating exports before tariffs hit, and perhaps we're seeing an extension of that trend as well. So just recapping those numbers, second quarter final GDP rising 4.4% on year, in line with expectations. Okay, we're just getting a little bit of news as well. I mentioned that tariff truce that the U.S. announced, and China says it has agreed with the United States to extend that tariff truce from 90 days. So those talks are continuing, and as I mentioned, that was widely expected. Let's get to our next guest, who continues, meanwhile, to favour U.S. tech stocks. We're joined now by Kieran Calder, Head of Asia Equity Research at UBP. And Kieran, we've seen a little bit of action in terms of US tech in the past few days. Of course, President Trump applying pressure to the Intel CEO and then appearing to back off, making deals on revenue sharing with AMD and Nvidia when it comes to exporting chips to China. Would you see this sort of political involvement in tech companies, though? Does it make you at all nervous?
Good morning. Yeah, I mean, I think it's obviously not the base case that we'd like to see, but it's the new reality under the Trump administration, where President Trump specifically wants to get involved in things. So I think the revenue sharing on China business for Nvidia and AMD is interesting. For the companies themselves, I guess it's better to have 85% of the revenue than leave the whole market to Huawei. So it's a little bit of, I guess, pragmatism on their parts. But for us, you mentioned we like U.S. tech. If we sort of back up, we think that at this stage in the cycle, we recommend a full allocation to global equities. We have a bias towards sectors with decent earnings visibility. So that's what leaves us in U.S. tech, and also we think utilities looks interesting from that perspective. Also against likely lower interest rate path from here, and we also think it's given the macro uncertainty, it's really a stock picker's market, and there's several sectors and specific stocks obviously that we want to focus on.
There are always questions, however, on the valuations that we're seeing in the tech sector as well. They're looking fairly rich. Does that give you any pause when it comes to adding to your allocations?
Yeah, I mean, of course, we're at near all-time highs in terms of valuation. It continues to be supported by earnings, and it's one of the, it's the main factor that goes into stock reaction after earnings hit or miss. So we're a little bit cautious. The run-up since post-Liberation Day is probably a reason not to be aggressively adding at this point. But if we look at our sort of weighting across the equity part of our portfolio, we do have an overweight weighting, which we're keeping in tech and also in utilities.
As you were speaking there, we just saw some breaking news that we've got Japan's Nikkei index now catching up with the topics. It's trading above its record high closing level as well. What's your exposure to Japan at the moment?
Yeah, we're about equal weight in Japan. We think that there's some, again, great stock-specific stories there. If you look at some of the leaders coming out of recent, fiscal first quarter results for Japan, the big gaming names, Nintendo and Sony, have had a great quarter. Even SoftBank, the sentiment has turned, and we've started to see a bit of a narrowing of the discount there. And really, the story has become all about AI. So they've really been able to flip the script there. But again, it highlights, it's not the market. It's really stock specific and maybe even sector specific stories which are leading.
Yeah, exactly, and that rally happening on the backdrop of a lot of uncertainty for the auto industry and the supply chain that relies on it as well. And I know when it comes to materials and supply chain imports, that is one sector that you're cautious on, but how much confidence have you have that some of this tariff risk might now be receding?
It's a big question. We think that we've passed peak tariff uncertainty, and there's even a trade policy uncertainty index, which peaked in April. Still very high, 19 standard deviations above the 40-year average before November, but has peaked. We think the market's gotten a lot more used to the pattern of President Trump putting up a large number and then negotiating down. Also, obviously, pause, as we've seen in the case of China again, is part of the strategy. So we think that, we've passed peak uncertainty regarding tariffs. We would expect a big deal to be done related to China, certainly before October. It meets everybody's political calendar. And then we'll have to be, then that'll be most of the global trade wrapped up in terms of tariff. A few countries left out at the moment, Canada, but a lot of trade is already covered in in what used to be called NAFTA. And we think a lot of the market has become a lot more comfortable, or maybe resigned to tariffs ahead, and we've kind of settled most of them.
Just want to look ahead also to an important piece of data we're going to get within the next 24 hours, and that is, of course, the US CPI numbers for the month of July. Now, there's a lot of variance in terms of expectations here about whether we've seen tariff feed through yet. If we have, how enduring is it going to be? How are you weighing the possibilities at the moment around US inflation?
Yeah, well, we're obviously very concerned, and we don't think that the tariff wave has hit. That'll be, we think, a second half story. But if you look at the jobs data and the big revisions that came recently, the inflation data, and will that tick up again? I mean, it's a good chance that we're at an inflection point in terms of both of those readings. And against that, obviously, you've got the new, or maybe harder pressure on the Fed to possibly cut as early as next month. So we think there's probably a window to cut ahead of some of the data looking really bad, if that's what the Fed wants to do. So for us, we think that the inflation print tomorrow will be extremely important. And in any case, we would expect probably a 25 basis point cut in September, and certainly in October, if not September.
Which might suggest a weaker dollar as well, which we did see rally over the past 24 hours. But do you feel the path of least resistance for the greenback here is down?
Yeah, we also think that the long-term trend for the dollar is weaker against and obviously, so we've seen a lot of strength in currencies around this part of the world, including the Singapore dollar. You just mentioned the second quarter GDP came in as expected, but I think the important part out of that press release from the MTI was that they've revised up their full-year guidance for GDP from 0 to 2 to 1.5 to 2.5. So countries, small open economies like Singapore are able to negotiate and deal with the current uncertainty pretty well, actually.
All right, Kieran Calder, head of Asia Equity Research at UBP. Thanks so much for joining us. And we do have more ahead on the Asia trade. This is Bloomberg. President Trump has signed an executive order extending the U.S. tariff truce with China for 90 days. In a social media post, he says all other elements of the agreement will remain the same. Earlier, the president also signaled he's open to allowing Nvidia to sell China a scaled-back version of its most advanced AI chip. Let's get more on all of this with Bloomberg's China correspondent Min Lo. Min, I want to start with that extension to trade negotiations. I think everybody saw that one coming, right? What's next?
Yes, it is highly anticipated, and just a sense of how coordinated the messaging had been. Both China and U.S. had released their version of the statement at around 8 a.m. Beijing time today. China reiterating that the tariff truce will be in place, that it will continue to suspend or remove some of these non-tariff countermeasures as well, which is include things like the anti-monopoly investigation into certain companies or placing certain U.S. companies on an unreliable entity list, for example. But both sides maintaining the tariffs at current level. And of course, this means that they are kicking the can down the road for another 90 days as we plan for this potential meeting between President Trump and Xi. Trump already said he's planning to meet Xi before the end of the year, but October could be a potential window when the APEC summit is taking place in South Korea. And this trade truce buys them more time to work on some of the details of this trade agreement. we know that China, for example, will want to get the fentanyl-related 20% tariffs removed. China has also been pushing for the rollback of some of these tech curbs on Chinese tech curbs on China. And of course, the U.S. had been scrutinizing Chinese purchases of oil from Russia. President Trump also calling for China to quadruple its soybean purchases from the U.S. as well. And of course, as you said, chips had been in focus for a long time as well.
Yeah, let's talk a little bit more about the issue on chips. President Trump signaling that he might be open to Nvidia selling China a scaled-down version of its most advanced chip. Let's have a listen.
I deal with Jensen, who's a great guy, and Nvidia. The chip that we're talking about, the H20, it's an old chip. China already has it in a different form, different name, but they have it. Or they have a combination of two will make up for it and even then some. The Blackwell is super duper advanced. I wouldn't make a deal with that, although it's possible I'd make a deal, a somewhat enhanced in a negative way Blackwell. In other words, take 30% to 50% off of it. But that's the latest and the greatest in the world. Nobody has it. They won't have it for 5 years. But the H20 is obsolete. You know, it's one of those things, but it still has a market.
Let's dig into this idea a little bit more, Min Min. I mean, first off, does this mean that the U.S. is now prepared to negotiate on items that were previously export-controlled? But secondly, would China want a scaled-back Blackwell chip, considering it's unhappy about the security vulnerabilities of the chips it's already able to access?
Yes, it does seem like President Trump might be willing to consider trading off some of these national security concerns in exchange for some type of concession from Nvidia, for example, because Nvidia recently came into a deal with the U.S. government, giving the government a 15% cut of its China sales in exchange for export licenses for the H20 chips. Now, the H20 chips is something that China has raised concerns about, the security concerns that the U.S. could install backdoors in these chips, installing location tracking capabilities to ensure they don't fall into the wrong hands. This is something China has flagged, but some of the concerns is not just regarding security. If you look at the state media pieces so far, they are also talking about how it's not the most advanced chips available. It is not energy efficient as well. So by all accounts, there is just no reason that Chinese consumers should be choosing to buy the H20 chips. So it is possible that maybe China might be enticed by the more advanced version, the Blackwell chips, even if it's scaled back a little bit. Again, it looks like both sides, both China and the U.S., perhaps willing to trade chips for a price. China and U.S. both may be willing to trade away some of that security risk in exchange for something that is more valuable for them.
All right, Bloomberg's China correspondent Min Min Lo there. In other news out of the White House, President Trump has named E.J. Antoni to lead the Bureau of Labor Statistics. That's after firing the previous chief following weak July payrolls data. Antoni is chief economist of the conservative Heritage Foundation and has been vocal about his concerns with BLS jobs data and revisions. The position is subject to Senate confirmation. And President Trump has reversed his criticism of Intel CEO Lip-Bu Tan after talks at the White House. Trump described their meeting as very interesting, calling Tan's success and rise an amazing story. Last week, the president called for Tan's immediate resignation, accusing him of unspecified conflicts of interest. And the president has used his Truth Social platform to declare that imports of gold will not face U.S. tariffs. A White House official suggested last week the administration would issue a new policy after U.S. Customs and Border Protection stunned traders by deciding the imports would be subject to duties. More ahead on the Asia trade. This is Bloomberg.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed.
President Trump there playing down expectations for his upcoming meeting with Russian leader Vladimir Putin as he seeks to end the war in Ukraine. For more, Bloomberg editor Jill Desis is with us. And Jill, the president saying there that he feels President Putin wants to get involved, wants to end this. That's probably correct, but on President Putin's terms, one would expect.
Yes, Paul, I think, this really just kind of speaks to how long this has really been going on here. I think when it comes to Trump in particular, obviously he's expressed quite a lot of frustration over the last few months. This is a campaign promise that he had made that as soon as he was entering, as soon as he entered office, that he was going to end the war in Ukraine. Obviously, that has not happened. There's still a lot of sticking points when it comes to what ultimately would lead to a ceasefire here. We have Putin, of course, would be demanding some concessions on land, particularly in the eastern Donbas region, as well as Crimea, which it annexed back in 2014. Zelenskyy, though, has made clear, even just this week, that obviously he's not really exactly open to those kinds of land seizures and such. That may be something that ends up being a pretty significant part of these conversations. I think what's really important to remember, though, is that just ahead of this meeting that Trump himself is doing with Putin, he is meeting with some European leaders, including with Zelenskiy as well. So that's supposed to be taking place Wednesday. Possibly some terms discussed in that meeting before he goes ahead and meets with Putin. I imagine, though, that if you're Zelenskiy, if you're these European leaders, also obviously pushing for an end to the ceasefire, but you may be wondering what could be happening in that Trump-Putin meeting that you're not necessarily privy to until those two sides break after that August 15th meeting. So again, lots of potential for some developments this week, but again, as we know, this has been something that has been of deep frustration to the President of the United States, his inability to kind of end this war. Whether he actually reaches a breakthrough this week, I think that's what we'll have to see with this meeting.
Yeah, you mentioned that he's also meeting beforehand with European leaders and the Russian President Vladimir Zelenskiy. What sorts of security guarantees are going to need to be agreed to here? Because, of course, Vladimir Putin has a track record when it comes to slicing off pieces of Ukraine.
Yes, that's right. So I think, what we've heard from NATO so far is that land discussion would have to be on the table. And Trump himself has said that he believes that there would have to be, at least some land that's up for discussion here. Again, I think that when it comes to Ukraine's Zelenskiy, that's a very difficult, sort of pill to swallow there. But it does seem like at least there's, some agreement there, particularly when you're looking at, Trump, who's really kind of trying to drive, this ceasefire in many ways. That does seem to be something that at least has to be up for discussion. But really, I think the question becomes, whatever's discussed in this meeting between Zelenskiy and Trump and these European leaders, how much of that is actually going to transfer over and carry through to this Trump-Putin meeting? I think that's really kind of the open question here. Remains to be seen, which tells us that, no matter what it's ultimately discussed during this pre-briefing on Wednesday, it really kind of it remains to be seen when push comes to shove what happens in that Trump-Putin meeting and whether that ultimately results in something that could potentially lead to a ceasefire.
All right, Bloomberg's Jill Desis there. Other stories that were following. The Trump administration said to have expanded its list of potential new Fed chairs. Officials say the central bank's two vice chairs, Michelle Bowman and Philip Jefferson, are now under consideration. And that's along with Dallas Fed President Lori Logan. Treasury Secretary Scott Bessent will interview additional candidates in coming weeks and shortlist individuals he recommends to meet with President Trump. An explosion at a U.S. steel plant in Pennsylvania has killed at least one person and injured 10. The company says the incident involves coke oven batteries at its Clairton plant. U.S. Steel CEO David Burritt says the firm is working closely with authorities to investigate the cause. The plant's got a history of accidents and violations, including an explosion and fire in 2010 that injured 15 people. Two Chinese ships have collided after one of them chased a Philippine Coast Guard vessel in the South China Sea in the latest encounter between the two nations in the disputed waterway. The Philippine Coast Guard released video and photos of the incident, said to show a China Coast Guard vessel hitting a Chinese Navy ship. The Philippines says the China Coast Guard ship suffered substantial damage. Let's take a look at European futures. We got a little bit of positivity there as well, following on from some of the risk-on sentiment that we're seeing here in the Asia Pacific. We're going to get UK job numbers for July a little bit later on. Expected to see unemployment there hold steady at 4.7%. Pay growth forecast seen easing as well. In the macro picture, we've got European gas prices rising as a heat wave grips Europe. And in rather interesting news, France closed 4 nuclear reactors due to a jellyfish swarm making its way into cooling water filters. Let's take a look at how Japanese assets are tracking. Meanwhile, coming back from the long weekend, public holiday on Monday, of course, and bouncing back pretty strongly. We do have the Nikkei at a record, in fact, rising 1.98% now, just a shade under 2%. We've got a very weak yen there as well, perhaps a function of a strengthening US dollar. We've seen a little bit of dollar strength in the past 24 hours as well. Not a lot of movement there on the Japanese 10-year. I just want to bring you up to date on Rakuten as well. That stock now better by 3.4%. Rakuten did report on Friday after the close. It was not a fantastic set of numbers at all, but that stock's still rebounding quite nicely. Take a look at some of the other assets that we're tracking. We've got the dollar spot index I mentioned showing a little bit of strength, although it's proving me wrong right now, pulling back just a tad, but the dollar was up a bit earlier. The 10-year yields also holding pretty steady there at 4.28. S&P futures in very modestly positive territory ahead of that CPI data for July coming out from the US tomorrow. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how some of the key currencies that we track are going at the moment. We've seen a little bit of dollar strength, perhaps contributing to the yen weakness that we're seeing. The Aussie dollar, not a lot of change at the moment, 65.17. We do, of course, have a central bank decision today, and one would imagine that a lot of that action already priced in, because we have all 36 economists in a Bloomberg survey expecting the Reserve Bank of Australia to cut the cash rate today by 25 basis points, and this comes as labour market data indicates more slack than the central bank had projected back in May. Also predicting a cut today, our very own Bloomberg economist, James McIntyre. So, James, markets were a bit taken aback 5 weeks ago. We were anticipating a cut. It did not materialise. You, however, were not surprised, but like everyone else, you are expecting a cut today.
Yeah, that's right. We didn't think that there was a real need to cut five weeks ago at the July meeting. The data at the time was suggesting that the labour market was pretty tight. The monthly inflation data was suggesting things were a bit weak, and I think markets got really quite a bit carried away with that, whereas the RBA has been for some time suggesting that the quarterly was much more important, that quarterly CPI data, which we received now for the August meeting. And so we think that was the reasons why they held in July don't necessarily hold today, especially around that labour market, which we've got the unemployment rate that's been revised upwards and now is clearly suggesting that there's a bit more slack and some room for the RBA to move.
Well, the RBA's got a dual mandate, but they can't ignore the bigger picture at the same time. Is there any consideration here from the trade environment?
Look, trade's not going to be a huge direct impact on Australia. Most of our exports are commodities, and we do have one of the better trade deals with the US to the extent that things are better, with only that 10% reciprocal tariff. But the bigger trade impact, what the RBA is probably really going to be considering and worried about, would be any of the uncertainty shock from what's gone on with the evolution of US economic policy over the last few months following the Liberation Day. And that's a real challenge for the RBA in Australia, given what's happening in the domestic economy. We're hoping that after strong public sector demand-driven growth in 2023 and 2024, that the private sector side of the economy, consumer spending, business investments, really going to pick up this year. But if there's a big confidence shock, which is what we've seen the initial response be, and that happens to drive consumers to close their wallets, sit on their hands, and maybe sees firms take a second guess yes about unleashing those investment plans. If that happens and we don't get that private sector pickup, that's something from the trade side of things that the RBA will be worried about those sorts of spillovers, and they might need to respond with rate cuts later this year or early next.
Yeah, well, let's talk about the future because, as you mentioned, we do get another set of forecasts as well. So what can we anticipate down the track, and what kind of commentary do you think we'll hear later?
Well, I think one way which you probably could couch or describe the RBA's commentary is that it's likely to be a relatively hawkish cut. Now, they are going to be delivering further easing. The RBA has told us, and we know, that they think that the interest rate is too high for what we need. It's above neutral. It's contractionary. But the economy is not screaming that they need to rush into an easing or stimulatory state right now. It's more about a gradual return to neutral, and in my view, I think we might need to move beyond that next year. So what we're likely to get from the RBA is a continuation of that cautious cutting, very deliberate and data-driven. And so I think that we'll be seeing them signal that there's further easing, but it's not likely to come straight away. Maybe at those quarterly meetings where we'll get the full updates. The update we're going to get today is going to have another 6 months on their forecast profile, and that's probably going to be enough to pull them over the line.
All right, Bloomberg economist James McIntyre there. Let's take a look at how commodities have been tracking, because it's certainly been an interesting week in terms of the three that you see on your screen there. Gold finally settling down after all the drama that we've seen. We'll get into that in a minute. Iron ore is an interesting one as well, because we have had news from China in the past 24 hours that a number of steel mills are going to be closed. That's mainly due to oil air quality, but perhaps something to do with overcapacity as well. Oil prices holding reasonably steady at the moment. Brent crude just ticking up by 1/3%. All right, let's get into more on this with the Energy and Commodities editor Andrew Janes. And Andrew, I want to start off with the action that we saw in the gold price. As I mentioned, it seems to have settled down now, but there was a concern that it might be subject to tariffs. So, to a degree, this plays into, the is it a commodity, is it a currency debate around gold, right?
Yeah, that's right, Paul. It's been a tumultuous few sessions for gold, although mainly in the US prices as opposed to the global benchmark traded in London. This was sparked late last week by an FT report that said that the Trump administration would put tariffs on gold bars, 1 kilogram and 100 ounce gold bars, which are heavily traded around the world. That caused the price in the US to surge on Friday, a big dislocation with the London price. As you say, gold it's an investment asset. It's essentially a currency, really. So tariffs on gold bars would have almost been like a tariff on a currency, and would have really gummed up the market, caused really big dislocations between the prices in New York and London. Trump's come out with a social media post today saying the tariffs won't happen, so it appears sanity has prevailed there, although, as always with the Trump administration, we don't yet have any details.
That's right. We do have the 5 words on social media. Gold will not be tariffed, but no formal policy yet. Tell us about what's happening with iron ore, though, as well, because we've got the news that a number of Chinese steel mills are going to temporarily halt output. This is helping support iron ore prices, but for how long?
That's right, Paul. So this is in Tangshan, which is a big steel-making hub, reasonably close to Beijing. There's a big military parade happening in Beijing on September 3, and so some of these mills have been ordered to shut down or reduce activity. This is something China does quite often. It likes to ensure clear skies for big parades and events. You see it around sporting events and stuff as well. The bigger question, I guess, is this part of the so-called anti-involution campaign? This has stepped up efforts in Beijing to reduce overcapacity across several sectors in the economy. Hard to say if it is. So the big question really is, what extent do steel mills get included in this big campaign to tackle overcapacity? On the one hand, if you are getting steel mills to produce a lot less steel, that may reduce demand for iron ore, but on the other hand, this should be good for the sector and help margins, so it can also be seen as a bit of a positive for iron ore, and actually iron ore prices have tended to rise on speculation that this will happen.
All right, Asia Energy and Commodities editor there, Andrew Janes. Let's get the latest on the corporate front. Micron has raised its fiscal fourth quarter sales and profit outlook, citing stronger DRAM prices and high bandwidth memory demand. Revenue is now seen at up to $11.3 billion, with earnings as high as $2.92 a share. Shares closed more than 4% higher. Micron has been one of the best performing chip stocks this year. Ford has unveiled a $5 billion plan for a new line of budget electric vehicles, starting with a $30,000 pickup truck set to roll out in 2027. CEO Jim Farley calls it a bet to take on Chinese rivals, warning there are no guarantees in the unpredictable US EV market. Now, the plan includes a $2 billion overhaul of Ford's Louisville plant. Paramount is buying the exclusive rights to show all events from the Ultimate Fighting Championship in the US. The 7-year deal is worth $7.7 billion and bolsters the Paramount Plus streaming service. UFC owner TKO Group jumped 10% in New York trading. Paramount says it will also look at buying international rights in the future as they become available. Right, we've got the Nikkei at a record, so let's take a look at some of the key stocks that are moving at the moment. Rakuten Group now up more than 3%. It did deliver a rather depressing set of numbers on Friday, but the market reacting warmly. Some of the analysts are saying there's no surprises really in that bad result, but the earnings do signal a sustained profit turnaround via cost controls. Take a look at Olympus, though, sinking by about 7%, cutting its operating income guidance for the full year. The guidance, though, did still beat the top analyst estimate. And another stock that we're watching there is Sharp, up more than 7%. Sharp boosting its operational income guidance for the full year, even though that guidance did miss the average analyst estimate. Operating income for the first quarter for Sharp, 15.3 billion yen. That blew estimates out of the water, more than 3 times higher. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how our Australian assets are tracking. It's a fairly positive day for Australia at the moment, seeing modest gains here. We've got the Aussie dollar holding on just above 65 cents as well. That is, of course, Reserve Bank of Australia decision day. Bit of a mixed bag in terms of the best performers. We saw a big pop in lithium stocks yesterday. That's not a trend that we're seeing continue into today. But it is, of course, the start of earnings season here in Australia. We've got the RBA, as I mentioned, also, and here to help us unpack all of this, we're joined by Jason Steed, JPMorgan Head of Australia Research. Jason, thanks for your time today and for coming in. Earnings season getting underway. Any particular sectors, companies that you're watching for outperformance?
I think what we're anticipating is a very volatile season. We published a report recently describing this as the tempest, and I think even in the first week or so of the season we've seen that. We've seen some very extreme moves, both on the upside, stocks like Credit Corp doing very well, and then we've seen more difficult days, for stocks trending lower, like JB Hi-Fi yesterday. So I think that is really a vignette of what's ahead for the season. But when we look at where there is the prospect for earnings growth, so healthcare is an example where there have no doubt been challenges. The biggest healthcare stock, as we know well, CSL, has been through a long period of derating, but it is one of the sectors that offers growth. And I think increasingly investors are looking towards where can we find high single-digit, double-digit growth. And equally, I'd probably say tech is landing in that territory as well.
A company like CSL, though, also exposed to, uncertainty. We don't know when it comes to trade what will happen with pharmaceutical pharmaceutical tariffs, that type of thing. When you cast your eye across Australia's listed companies, is that something you think these trade exposed ones might have an interesting few quarters?
I think without doubt. I think as we know and are experiencing almost day by day, there is just persistent uncertainty as to where tariffs might land, which countries are going to get hit hardest, which sectors, particularly pharmaceuticals, as you mentioned, is an area of concern. But I think from the point of view of the longer-term picture for a company like CSL, or indeed a company like ResMed, we can see the growth profile being generally pretty robust. So we can feel some confidence around that. But without question, you're right. In the short term, it is more challenging. And I think that's why we've seen, not singularly, but quite a few of the domestic cyclical sectors do pretty well, because they're not facing that tariff uncertainty, that day-by-day whipsawing that comes from the pronouncements that do change very regularly, as we know.
Well, it's not just those pronouncements as well, because on the other side of the Pacific, we have China dealing with its overcapacity issue,
yes.
and that's obviously got major implications for Australia's minerals sector. So do you see that being played out in the numbers?
I think not in the short term, of course, but there's no question when we hear from the lithium companies, which have, you mentioned at the outset of this segment, are doing tremendously well on the anti-involution story that's building in China. And I think certainly with sectors where there has been significant overcapacity, like lithium, there is the prospect that when the companies report or when they talk about their outlook, that they're going to talk to this fact that the supply side is now more constrained, and that's going to be beneficial to performance. But I think overall this sense that there is perhaps some supply side discipline coming into the equation in China is very important, because for a long period of time that overcapacity, that additional uncertainty, which plays into your point as well as tariff uncertainty, has been a negative factor for a lot of the materials companies in our market.
We do have to talk about Commonwealth Bank as well, because it is, I refer to the 900-pound gorilla of the ASX. Yes. I think it's a tenth of the index by weight or something like that. Now, it's up 37% on year. There's always commentary around this stock about how overpriced it looks, yet it keeps defying gravity. Now, a lot of interest seems to come from overseas investors. Do you see that as a vote of confidence in Australia, and can these sorts of gains be sustained?
I think the gains will be difficult to continue on. I'm not sure we're going to see further gains. And I think what we'll need to see from the CBA and from other banks, which obviously don't report, certainly not the other three majors in this season, but is evidence that there is some growth in the next 2 to 3 years. I think that's the biggest issue for our banks at the moment, is there is very limited and in some cases negative earnings growth over the next 2 to 3 years. And if you're running with a multiple, like CBA does at the moment, 30 times earnings, well over 3 times book, and a dividend yield of sub 3%, we're going to need to see something in the numbers that gives us confidence, one, that they can continue to maintain levels of return, but more importantly, I think that there's some growth in the next 2 to 3 years, which right now is difficult to see. Credit growth is and will pick up, we think, with the RBA, but the reality is that might generate 2 to 3% earnings growth, which is pretty low in the context of some of these elevated multiples that we see across the sector.
Yeah, and in terms of the RBA, I mean, we're expected to see the easing cycle continue at that gradual pace today. Pretty much everybody, yourself included, I'm sure, is anticipating a 25 basis point reduction. Where to from here, though?
So yes, we are in the camp. I'm not sure of anyone that isn't in the camp of a 25 bip cut today. Where we are slightly different, though, and this is our economics team, we only expect one further cut beyond today. So if we look at market pricing, I think it's closer to 3. So we see the RBA reaching a point of comfort with another 50 bips from where we are today. And then what that leaves behind is how much more can that juice the economy? How much more does that juice the housing market, to the extent that if we look at what the ultimate drivers are for the banks and Australian domestic cyclicals, it is the health of the consumer. It is how much the consumer's spending. 2 more rate cuts will help, no question. Is it going to put a rocket under those 2? I don't think so. That's the challenge for us.
Yes, the property market, though, continues to defy expectations.
It does, yeah.
But off the back of that meeting 5 weeks ago, where so many people did expect a cut and it didn't happen, questions got asked about the communications from the Reserve Bank. How do you feel communications has been?
Well, there's no doubt communication, the frequency, the extent, and the times that we see the governor have increased. So I think that certainly helps because we do get a broader range of points of reference. I think it's very difficult in an environment where inflation is distorted by different factors such as subsidies, where there is this global uncertainty, to at any one point in time say everything that you have on the table is enough to meet the market's expectations. So I understand when there might be points in time where there is a divergence, and frankly, from a market perspective, I think we should welcome that because sometimes that uncertainty brings about opportunity. So from my point of view, I think the RBA worked with what they had in hand at the time, and I think clearly today, with the data we've had since the last decision, it's a much clearer path for them. But I guess we'll see at 2:30.
We will, not long to wait. All right, Jason, thanks so much for joining us. Jason Steed, Head of Australia Equity Research at JPMorgan. And tomorrow we'll be speaking first with Evolution Mining Managing Director and CEO Laurie Conway about full-year results from Australia's second largest gold miner on the ASX. That interview Wednesday, 9:15 a.m. Sydney, 7:15 a.m. if you're watching in Hong Kong. We have more on Australia ahead every Tuesday, 10:40 a.m. if you're watching in Sydney. That's 8:40 a.m. in Hong Kong. This is Bloomberg. Let's take a look at how futures are tracking ahead of the open in China and Taiwan. A little bit of softness there. Earlier, of course, we did have the news that the trade truce between the United States and China will be extended for a further 90 days. That news catching absolutely nobody off guard. That was widely expected. We didn't see any market reaction in the US, and futures here, not a great deal of change there either. US futures, meanwhile, pointing higher by just a few points. All right, well, let's get a preview of the market open in China. Our managing editor for Asia Equities joins us, Lianting Tu. So, Lianting, what are you expecting in terms of market reaction, if any, to the news of that extension of the tariff truce between China and the US?
Morning, Paul. Yeah, as you said, I think a muted reaction is what people expect, just because there have been so much news in the last week pointing to a potential truce. And the mood music between the two nations has been relatively positive, with Trump talking up a meeting with Xi, and even the Nvidia chip news is pointing to sort of a constructive tone between the two countries, even with chip exports. So the market investor attention right now is really shifted to earnings. We have a slew of internet giants from China reporting earnings in the next few days and weeks. So Tencent will be the next one reporting tomorrow, and we'll also have the likes of Baba, Xiaomi, and Meituan reporting by the end of this month. So that will really be the next catalyst for the Hong Kong-listed Chinese stocks going forward.
Yeah, and China's mainland stock market's been doing pretty well recently as well. What's driving the rally?
Yeah, it's been going quite well. CSI 300 has had the fourth consecutive months of gains, and it has been outperforming Hong Kong stocks, in fact, for 2 straight months. The reason mainly is the ample liquidity going on onshore. We have seen rising household savings, and there's insurance funds going into, or I should say more insurance funds going into the onshore market as well. And that is resulting in a number of indices having some kind of fresh milestones. If you look at Shanghai Composite, we're very close to taking out the intraday October 8th high to reach the highest since 2021. It could easily be achieved today. And there is some froth forming in some corners of the onshore market as well. If you look at small cap index CSI 2000, and that index is almost at the highest in 8 years, and margin trading is at decade high. So we're seeing some kind of a speculation going on in the onshore market, while most of the people believe that the onshore rally still has a little bit of legs. There is also another camp saying that the rally may not be sustained without meaningful improvement in earnings and the macro economy.
All right, Bloomberg's managing editor for Asian equities there, Lian Ting Tu. Let's take a look at how our benchmarks are tracking across those markets that are open. It is a modestly risk-on day here in Australia, ahead of the Reserve Bank of Australia meeting in a few hours' time. We are expecting that reduction of 25 basis points, as I mentioned. But take a look at the Nikkei. Back from a 3-day holiday, it's off to the races, better by 2%. The Nikkei at a record at the moment. The Kospi also higher by almost 1%. That is it from the Asia trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen.